Okay, imagine this. You buy a house today and you finally make that last mortgage payment in the year 2075.
Whoa. I'll be what, 90 years old? That is terrifying.
Right? But that is the buzz right now, the 50-year mortgage. Lenders are floating it as a way to solve the affordability crisis.
50 years. It sounds like a prison sentence. But does it actually help people buy homes?
Well, on paper, sort of. It lowers your monthly payment. But Benjamin Sheekin over at HousingWire wrote a great piece arguing that it's really just a math trick.
A trick how?
It makes the monthly number look smaller, sure, but the house is still just as expensive. Actually, it's worse because the total cost you pay over time explodes.
So you're saving a few $100 a month, but paying double for the house in the long run?
Exactly. And there's a huge structural problem here, too. We call it the Fannie and Freddie problem.
The government-backed entities? Do they not like these loans?
They won't touch them. Anything over 30 years is non-conforming. That means lenders can't easily sell these loans. They have to keep the risk on their own books.
Which usually means higher interest rates for the borrower, right? So much for saving money.
And here's the kicker, equity. With a 50-year loan, you are building equity at a snail's pace.
Because you're paying almost entirely interest for the first decade?
Bingo. Sheekin makes this point. Say you take a 50-year loan, and 7 years later you want to refinance into a 30-year. You will owe significantly more principal than if you just started with a 30-year loan.
You're basically treading water for 7 years.
Is there anyone this actually works for? Like a specific type of person?
Maybe. There's a narrow use case. Think of someone just starting a high-earning career, like a doctor in residency. They know their income is going to jump up soon.
So they take the low payment now, intending to refinance later?
Right, but that requires strict planning.
Here is the macroeconomic nightmare scenario. If you lower monthly payments, what happens?
More people can qualify for loans.
Correct. And when more people qualify to buy the same limited number of houses,
Prices go up. It's supply and demand 101.
exactly. A 50-year mortgage stimulates demand without fixing supply. It could actually make homes less affordable by pushing prices even higher.
It feels like we're just stretching the timeline because people are buying later in life.
You nailed it. The average first-time buyer is hovering around 40 years old now. Wages haven't kept up with home prices, so people have to save longer.
And giving a 40-year-old a 50-year mortgage, the math gets weird. They'll be 90 when it's paid off.
It doesn't fix the income to price gap. It just lets you access that high price differently. There's also the risk factor. We have decades of data on how people handle 30-year mortgages during a recession.
And for 50-year loans?
Nothing. It's a ghost town. We don't know the default patterns. Lenders, investors, regulators, they'd be flying blind.
That uncertainty usually translates to higher costs for everyone involved.
And think about who takes this loan. Historically, weird financing is for rich people who want flexibility.
But a 50-year mortgage isn't a luxury product.
No, it attracts borrowers who have no other option. That is a much riskier borrower base. If the economy turns, those are the loans that go underwater first.
It feels predatory when you put it that way.
So the verdict? Sheekin puts it perfectly. It only buys time we do not actually have.
It's a Band-Aid on a bullet hole.
Pretty much. Until home prices come down to match incomes, creative loans are just workarounds. The problem isn't the mortgage timeline.
The problem is the price of the house. Loud and clear.